Perhaps I'll chip in. The ESG theme is emerging today, and together with the far-reaching effects of the COVID-19 pandemic, as well as the issues of social inequality, there's been greater interest in both ESG investing and sustainable finance from the environmental point of view, as well as the social aspect of it. So with this, and to relate to the theme of ESG and FinTech, basically the E and S aspects tend to be based on non-financial data, generally alternative data. And there seems to be a lot of effort in the climate tech and ESG tech area with regards to uh, FinTech investing as well. So hopefully we can help to address during our panel discussion with regards to such development, and we probably may need the four Ds to make the sustainable finance and ESG investing progress going forward. The first D could be in terms of your data, making sure the quality is good and relevant. The second D is with regards to the design as well as the definition. Hence, there's a lot of taxonomy involved in terms of focusing on the E and S and G. The third D with regards to the disclosure aspect in terms of making the transparency more evidence-based so that there is less likelihood for ESG or greenwashing. And the fourth D refer to the decarbonization strategies, whether man-made or natural, so that it could help to propagate in the attainment of the ESG objectives. So with that, I hopefully has started the ball rolling. So perhaps we can go on to Yan with his inputs with regards to the second theme, which is how fintech companies can play a role in terms of the ESG finance or sustainable finance going forward.
Sure. Thanks, Dagwan. I think, firstly, what's very interesting about the times is we're hearing a lot of ESG right now. And so there's certainly a movement there. I would say that, over 50% of global asset holders are gauging or applying ESG in their factors in their investments right now. So, there's been a surge, $50 billion of dollars into sustainable funds. So we're also seeing it from the client side, also demanding more. Previously, we used to see separation between ESG funds and traditional funds, and they're starting to merge together into one area. So the demand coming from the clients themselves, which is a great sign. And then with that, how are we going to solve for some of those challenges? There's still a big challenge around the data itself and the measurement and the transparency, which you had mentioned in the story. While improving, and it has to do with the better aggregation and understanding of the data, and you've kind of spoke to that. It is a complex challenge. For instance, we worked with a big pension company up here in the north, and found that they had many issues to assess the different factors of ESG. And even if you were to break apart the E factor, that could be water risk. And in terms of if you're an international investment with an international portfolio to manage, you have many different companies to track and their use of water, whether it be protecting from flooding or environmental impacts. And that is a lot of different sources of data inputs to then assess and come up with models to derive and your proper portfolio, the best recommended portfolio given the situation. Now, there are many other fintechs, and we could break apart each one, but we've certainly seen from our own portfolio investments, the E from an environmental standpoint, the S, and the G. Generically speaking, before I can give examples of a couple in each, but we do find that, when it comes to fintech or even startups, more often than not, we feel that in many cases, these startups are ESG focused. They just happened, they may not be fully at first labeled that way, as they may not have positioned themselves, or they have not had time to properly flesh out their triple bottom line as they're focused on building their business in a sustainable fashion themselves. But their impact that they do have in that space can be quite prominent. And I would argue that half of our portfolio of 35 companies is ESG. the side that sometimes is a little more challenging, though it might have a lesser number of fintechs and seems to be a bigger focus these days, would be in this story the E, and therefore the environment side of it. Although again, we have a couple examples of that and happy to share.
Thanks, Ian. Perhaps Svetla can chip in, because Svetla does a lot of work with the clients, especially in this ESG area. And after that, maybe Nick can round up in terms of the first thing that we are discussing in terms of the triangulation of ESG, sustainable investing, as well as fintech.
Sure. So the main challenge here is that there are no universally mandated standards around collecting ESG data or reporting on it. There are standards that exist, but they're voluntary. So, for example, there's frameworks like the SASB framework, which is a materiality framework, and it's a reporting methodology really that collects, data that is voluntarily reported by close to 900 companies that are using this framework to report. But then there is the issue of, do we trust that what they're reporting is true? So then there's a lot of companies that are doing the, public service, if you will, of collecting data outside of reported data. So data that comes from news articles or that comes from social media, like it could come from tweets or it could come from, any type of consumer reports. That allows for us to kind of verify whether the reported data is correct. And so I think that, if we talk about can fintech solve the problem of figuring out which portfolio is an ESG portfolio versus which one is not, as Jan was saying, most portfolios now integrate some level of ESG data in order to, even layer an additional lens of risk, mitigation on top of everything that they're doing already. But fintechs are, busy trying to figure out where to collect the data from and how to process it. So in many cases, they use methodologies like artificial intelligence or natural language processing in order to be able to provide that additional layer of transparency. And to kind of tie this back to what we do at AWS and, why do we have a stake at this and why are we even interested in ESG, because a lot of people don't really see the connection. So we launched Data Exchange back in November 2019. And in this data exchange, we, recently, as recent as last year, we added a portfolio of ESG data that's coming from third-party providers. So we have all the frameworks that you can think of. So you can report using data in the cloud, using whichever framework is the most appropriate for your portfolio. And then you can also layer that framework with other data coming from these types of third-party providers that I was talking about earlier, which collect additional data. And so this way you can have a very complete picture of the portfolio you're looking to assess. And you can even have almost real-time monitoring of risks associated with ESG. And so to answer the question, yes, fintechs are looking to solve this problem, and we are working with most of the prevalent ones in this space.
Yeah, and speaking of tech and fintech, I do apologize because my connection was cut off for 2 minutes, which shows you that in the in this day and age you need to have fintech and tech backups. But just to to wrap up the conversation, I think we need to have the capacity to harvest more systematically standardized ESG data, which can then be compared across sectors and geographies in order to make smart investment and policy decisions. And of course, a lot of the ESG investment world has been in part based on guesswork. The quality of the guesswork varies. Sometimes it's good guesswork, sometimes it's less good guesswork. But clearly, we haven't had, totally harmonized, standardized, in-depth data that can be, compared across sectors, industries, geographies. But things are moving, and I would say that things are moving to a large extent thanks to fintech. So really, it's but not only thanks to fintech. And we can see what happened, with the unfolding DWS saga in Frankfurt and on Wall Street in the past 5 weeks. I think it's a $1 trillion SEC greenwashing probe. So it tells you that the age of ESG by guesswork is really over. But it's not only because tech and fintech are really, as we shall see later today in that roundtable, are really allowing investors and policymakers to make, no pun intended, qualitative and quantitative leapfrog. But also it's because of two things, in my personal opinion. And by the way, I forgot to say at the beginning, so everything I say today is a reflection of my personal opinions and biases. So in my personal opinion, there's two drivers that are really being enhanced and magnified and empowered by fintech. One of them is very simple, is that the SEC 3 months ago has a new chairman, Gary Gensler. I think he took office at the end of April, so that would be like 4 or 5 months ago. And he's very much interested in fintech and harnessing the power of fintech to serve the ESG purpose in the realm of investment. So that's a big difference. And something else happened, which I think is also linked to what happens in Washington, D.C., because really, and I'm European and I'm proud to be European, but at the same time, I think in the world of finance, if things aren't aligned in Washington, D.C. and Wall Street, whatever you do in Montreal, Paris, Toronto, Brussels is beautiful, but I think it's not enough. And I think something else happened is like the largest pension funds in the world are actually U.S. public pension funds. So they are by far the largest investor category in the world. And until 5 or 6 months ago, these big public pension funds at federal, state, and municipal level were really hindered by the fact that, for example, the Secretary of Labor of the Trump administration was extremely hostile to ESG. And so basically, trust law and trusteeship and the fact that, pension board members have to flex their muscles. So basically, it's a chain of governance, right? And so before the CIO, before the chief investment officer of a large pension fund makes any decision, there are decisions being made before that by the board of that pension fund. So really, this is really where ESG starts, with pension fund trustees, board members. And until recently, they were hindered by the federal government in the US. And now everything changed with a progressive, more centrist, more ESG-friendly administration. So it's really great because there was a pent-up demand from the part of many pension investors for more ESG, more transparency, using fintech, regtech, etc. And I think now we're seeing that perfect, alignment of technology, policy, and regulation for the first time happening simultaneously in New York and Washington. And it's great because really, I think in the coming weeks, we should have some very positive news on that front. And so I think that there was another issue I think that we wanted to discuss today, which is, I guess, to focus a little more on climate change measurement and mitigation and, the whole clean tech remit. And for that, I'm returning to the Belle Province and tell us, Jan Christopher, what are the kind of company that you're helping, grow in that segment?
I think that overview is a bit of an echo. Maybe viewed at the same time. While I will say there has been a big shift, and thank you for pointing out the different factors that go into it, I certainly do believe demand has driven it as well. You had pointed out the big pensions. There are actually some really big ones in Canada, probably a couple at least in the top 12 in the world in terms of assets, for which there is a couple of reasons why they may look to do this. One is that they actually do believe that it has a better long-term impact on ROI, and others may do it because it's good marketing and on point with their brand in many ways. Either way, that is also driving it. And on the other side, from the rationale for brand is that the trustees, those who are requesting this, those for which will profit from their pension are asking for it. They're demanding increasingly more of this. So what is very positive in all this is very demand driven side of things. Now, the E in it has been somewhat later to be looked at. As mentioned, in the FinTech world, there's a lot more in the S&Gs. I'm happy to explain. We've invested in a couple, so I'll give you some examples. On the environment side, one of the biggest areas would have to be around, I'd say, farming and sustainable farming. So we looked at a company that would support farmers and what were the issues surrounding that. Some of the biggest issues for farmers, 1 in 14 people around the world are farmers, but challenges for them to get adequate financing was the inability for them to get loans because they weren't properly able to underwrite them. But you can use different forms of data, alternative data sets, including aerial and satellite imagery to better process information about a given farm and a given location to better illustrate the chances of making a return, or better illustrating that perhaps that farm does better in that area relative to others, or has a historically strong track record, relatively speaking. Even better yet is for the banks in this world, what we're seeing more on the financial services side, to be value add, to provide this information back to, yes, protect their investment, but instead of just offering a better commoditized product, is to give value added services that also then further embed themselves in a relationship, but protect also their investment while they go. So I think that's a very interesting and powerful story of how it uses, and that's more of a really focused case in the story. On the other side, we have looked at companies like FundSeeder. And this is for more, tracking and trying to identify the best trading strategies. And so we've seen it. FundSeeder is backed by the research of Jack Schwager, where he had roughly came up with the theory, and then they proved out the concept. I think they're up to 17,000 traders on their platform. So these traders attach their information, connect into it on their trades, because they're competitive and they want to show that they are the best trader, or to better improve their trades thereafter. In doing so, you can start to identify the best traders. You can also identify the best strategies. And for those that have made a conscious effort to focus on ESG, you can have better identify those particular strategies, better prove out the returns, which is still a bit of a challenge and needs to be overlooked, is still overlooked.
So for example, that company you mentioned, I think it's called Agrio, right?
The first one is Agro with respect to financing of loans. The second is FundSeeder.
Typically, Agrio, for example, are you selling these data mostly to banks and insurance companies in North America? Is it global? How does it work?
It's currently mostly on the Americas side. They're originally actually from Brazil. And so a lot of the interest was more locally in Brazil, as there's substantially a large number of farms. But also we've been assisting them enter the North American market. And it was very interesting, as 5 years ago, it wasn't quite ready. Even though the technology was kind of there, there was interest to see how to improve the models, but it never really took hold. But it seems like, like anything, it's not just the tech, it's the timing with their existing systems and better figuring out how to make it all come together. And it seems to be a great aspect. They have had interest in Europe. There's certainly a lot of other companies like that. We've seen several copycats, so to speak. So I think but it just shows that there's a need for it, if anything. And so we see that as very positive.
And one last question, because you titillated my appetite. So for example, what kind of tech are you using? So is it prop tech, or do you use other people's satellites? How does it work?
It's a combination of technology. I know for sure it's at least a portion is satellite and aerial imagery that's in there. They have hundreds of different data sets and so forth, tons of data to be able to, that's right, cross correlate and understand, triangulate, and make sense of what is actually occurring there. So lots of historical data as well that you have to process on top of that.
Nice, it's really fascinating. And now jumping from Montreal to Singapore, and maybe Dr. Hu can give us a flavor of one or two interesting companies he's seen or worked with in the recent past.
Oh, actually, what I've seen is the actual natural way to actually do decarbonization. But the challenge, of course, is the measurement, as you mentioned. So, for instance, a lot of the family businesses and assets in Southeast Asia are very tropical rainforest based, or like the forestry industry, or like agriculture, plantations, and things like that. So you see that a lot of the forestry themselves, they represent a carbon sink, a natural carbon sink. So because of their lack of maturity, the easiest way to start off in terms of promoting their, helping to monetize the assets to help the farmers to reduce the income inequality is to actually introduce them to a carbon exchange so that their carbon credits can be used as carbon offsets for those companies like the oil and gas companies who are looking to go up to the first stage of decarbonization. Say like coal companies that are extracting coal from the mines, it is very difficult to capture the carbon at the mines themselves, but perhaps they could actually buy the carbon credits from the forestry companies and things like that. Number two is that we have to actually harmonize, like what you say, the data collection and the definition, so that once it's harmonized, the standards are more globally accepted and it can be comparable, whether they are alternative database or financial database. Once you have that standardization, which is promoted initially by the EU with their taxonomy, a lot of companies in Asia are actually looking at the EU taxonomy and then modifying it to localize it to the specific industry in the region, right? So you have some form of regional or global standard being developed right now. So we are waiting for America to join in. And once it's done, then you have then in terms of developing a global benchmark or data, it would far be easier. And once you have the data, then it will be easier to evidence cases of greenwashing or ESG washing. And then finally, measuring the carbon footprint would imply that you have to measure the scope 1, scope 2, scope 3 emission. Most firms today can disclose their scope 1 and scope 2 emission. But scope 3 is very challenging because it depends on the ecosystem. So let's say you are traveling for business. When you travel for business, the airlines you took, the carbon greenhouse gas that is emitted is not part of the emission that was caused by your company. It's part of your tertiary exposure through your ecosystem. Measuring that is very difficult, but every contribution to each company, the scope 3 emission constitutes 70% to 80%. So that is the biggest thing that is a challenge right now. And if you can measure that, you probably are halfway there to actually assessing an more accurate carbon footprint. Yeah. So there are still some challenges in that sense.
Right. That's fascinating. And I like something that you raised, that people maybe on Wall Street or even in Brussels and the City of London may not be aware of. So that, in Asia in general, and more particularly in ASEAN countries like South Korea, Singapore, and also in China, the EU taxonomy has had a profound influence on policymakers, asset owners, pension funds, and sovereign funds, which is quite counterintuitive. So really, in big chunks of Asia, they really look up to Brussels, Paris, and they import and adjust and improve very often some of these ideas locally. And now I'm moving back to New York, I guess, to Svetla. I think you wanted to speak about the S and the G in ESG, Svetla, but you have anything to add regarding climate?
Sure. Yeah, I think, the question was like, what are some interesting companies that are doing things in this space? And I think I happen to work for one of the most fascinating companies in the world. So would love to tell you a little bit about what Amazon does in terms of, the environmental impacts, as well as AWS, which is, I think, the even more interesting part. So there is, in terms of Amazon, back in 2019, we co-founded the Climate Pledge, which is basically a pledge where corporates are pledging to be net zero carbon, to have net zero carbon emissions by 2040. And so there's a growing, while this is voluntary and there is no real mechanism to enforce that, companies are doing this. I think the growing number of signatories to this pledge is really promising. And then wanted to just chat with you a little bit about AWS as well, because when you think about data companies or companies that are focused on technology, you don't necessarily tend to think about the environmental impact. You think that there's more issues around the S and the G, which there totally are in terms of like treatment of data and security and prevention from hacking and how data is used and things like that. But from an environmental perspective, AWS is quite fascinating as well. So there was research that was done last year, actually, which looked to see what is the difference in terms of carbon footprint of companies that are built on-prem, technology companies, versus companies that utilize the cloud. And they found that the cloud is actually 88% more efficient in terms of performing tasks such as compute, because that's kind of where the footprint comes from. Really, it's compute and storage. And so if you have a SaaS offering that's built on the cloud, you're already 88% more environmentally friendly than your peers who are not using cloud technology. This applies specifically to AWS data centers because we have also pledged that our data centers are going to be using 100% renewable energy by 2025. And as far as I know, we're well on our way to achieve that. So this is pretty unusual or unexpected, if you will. So want to just share with you some of these anecdotes. But happy to move on to the S and the G aspects as well.
Yeah, if you had to give us the one main telling story or example of a client of yours with whom you work, focusing more on the S and or the G, what would it be?
Right. So, I mean, in terms of how customers are looking to weigh the data and what they're putting more emphasis on, this is completely up to them. Really, we don't necessarily tell them, what they should be doing. All we can do is share with them the tools and the methodologies that they could use, and then they have the flexibility of weighing data in whichever way makes sense for their customers, who are the ultimate influencers here in terms of where money is spent. But something that I have seen increasing attention on is not necessarily looking so much into assessing an investment portfolio, which, as we said, like there have been massive inflows of funds being put toward ESG portfolios. But now companies such as credit card companies even are looking to provide more visibility to their customers to see how their purchases are impacting the environment or social or governance issues. And I think that's a really fascinating problem because it requires such granularity of data. Even if you go on Amazon.com, you will notice that there are some products that are climate pledge friendly, meaning the companies that are producing those products are signatories of the climate pledge, and they are doing things, in order to, meet their obligations or their promises. But I think being able to in a very granular way, see what is the impact of purchasing, I don't know, a new bag on Amazon.com or whatever you're looking to shop for. I think this is like a very intense compute and data problem. I'm not saying it's not solvable. I just think that we will see a lot of evolution in this space with data becoming more and more granular and us being able to really connect everything that we do to our ESG impact.
Great. And of course, I use that sort of Trotskyite 1930s metaphor of the bloody crossroads where, economic, financial, and legal things, intersect. And of course, you guys work with the biggest, credit card companies in the world, and the wealth of largely untapped, not only financial data, but also sort of sociological, cultural, lifestyle data that is there every day, every week, every month is huge. And I guess, one of the main trends we'll be seeing in the coming weeks and months in terms of fintech investment will be, I'm talking billions of dollars moving in that direction in the amazing ways, largely untapped, that companies can use to mine these datas and exploit them. So I think that's going to be really one of the biggest, pillars or sources of activity in the fintech space in the coming weeks. And fintech, of course, includes insurtech and regtech. So we're using, that expansive definition. And maybe Jan-Christophe has something to add on that front.
Yeah, maybe I'll piggyback on the idea of behavioral data and its importance here. I'll also touch on we may have overlooked and don't think about, but credit scores and the way that we do credit scoring and the way that we don't do credit scoring. And so if you are fortunate to have a credit score, you are in the system and you can get access to credit. And it's a very powerful tool to be able to advance and play the game and have an economic prosperity. If you don't, it can be very challenging. And so we've invested in a couple companies, one of which, for instance, came out of the US and it was from individuals who actually did not have credit. And while they were on scholarships for university, they couldn't even get into housing, proper housing, because they didn't have a credit score. They were too young at the time as well. So they reverse engineered the FICO score and started to build an app for which you can improve your credit score through time, giving you tips and tricks to accelerate that. And so that you can then be referred and then improve your credit score in a very quick fashion. And so this was very interesting for financial institutions who can start saying, hey, we never have to say no to someone. We could say, hey, let's get you somewhere to start and let's help you build and let's get you into the system more quickly. In developing worlds as well, we noticed that there are just too many people who just aren't able to access the systems from traditional means. And so there must be other ways to write them. If you think the 4 C's of credit, one of the C's is character. And so how do you define a character? Well, there's a gamified approach. How you play games can tell a lot about your appetite for risk and your personality within. And therefore, they've actually built a system to properly underwrite many of those in developing countries to support them and assessing their credit and then distribute these loans in the story. So, this is a form of alternative data to make it happen. If we look at governance side of things, this is a huge area. We looked at areas like digital identity and in many countries with their own areas to move forward, but we're still short here. Having an ID is digital ID. Is incredibly important just in exercising your right to vote, which us fellow Canadians are actually doing today at the polls, or may have preemptively already done it, but or access into the rest of the system as well, right? And so how do you find a system that protects it? And we've invested in companies like Mat.ai to enable this and the transfer it in a secure fashion, so that really a wallet of your own identities, and so you don't have to pass all the information on. You can only pass a proportion of it. So lots of exciting stuff on the horizon right now, and that certainly I don't think there's any end in sight for many more interesting fintechs.
Oh yeah, I totally agree. I think it's clearly one of the hottest and most rapidly growing sectors of the economy for the next 5 or 6 years. And one more thing we don't have the time to talk to today. Maybe another roundtable in December or January with our friends from Adiva. But really, the whole crowdsourcing business and also the whole credit rating agency business, which is being revolutionized by fintech, and even the giants like S&P and Moody's and Fitch are kind of changing. So all that I think deserves a full hour of its own, later in the year or in January of next year. But I'm aware of time, and Juliana reminds me that we only have 6 minutes left. So let's make the most of it, which is basically trying to imagine the future, all of us here. So throwing a few ideas, but how we see the future in our crystal ball in the coming quarters. And I will start by saying that there's a very interesting phenomenon which is barely starting, and I think it started in New York City, and I think the Nasdaq precisely 2 months ago to the day, I think it was June 30 of this year, but whatever. They announced that they were the first amongst their peers to announce that they were launching a platform using some kind of improved or enhanced measurement technique based on the UN SDGs, the 17 Sustainable Development Goals, which is one way of seeing the world, which is quite a good way. And they announced 2 months ago that they were doing this. I think they call it the Nasdaq Esg Data Hub, and they were doing it with 7 partners. So they cherry-picked literally 7 partners, and so they sliced and diced further the world of ESG not into the UN's 17 Sustainable Development Goals per se, but they sliced this interestingly into 7 sectors or 7 angles. And I'm reading the angles from the Nasdaq website. So one of them is gender equality. The other one is biodiversity. The other one is reputational risk. The fourth one is climate risk. The fifth one is carbon emission. The sixth one is net impact, net zero. And the seventh one is renewable tech. And so they have cherry-picked 7 companies to join their platform. And 6 out of 7 are actually fintechs. Some are small fintechs, some are mid-sized, some are very big fintechs. But I think that's fascinating because I think only 1 out of 7 is an established German or Swiss insurance company. And the 6 others are fintechs, which says a lot. And of course, what you can expect in the coming days, literally, is to have the Nasdaq's competitors in Shanghai, Tokyo, Melbourne, and Paris do the same. So probably what you'll be seeing in the coming weeks is a series of such competing platforms. I think every big stock exchange and their sister, they will select 6 or 7 partners. So we may have like a worldwide, competition. It's really interesting, I think, as a development. That was sort of my strategic commentary. But let's go now to New York. What are you seeing, Svetla?
So thank you for bringing up this example. It's actually really interesting because we do work with the majority of exchanges around the globe, and we're seeing increasingly exchanges even from small countries in Europe or in Asia coming up to us and saying, hey, how can we source similar data? We want to make sure that our issuers are able to, report according to frameworks that are accepted by investors, because currently they're being basically excluded from portfolios that need to meet certain ESG requirements because of the mandates of their, holders. And so it's a really interesting problem because if you think about the big data providers, like the big names that everyone is familiar with, whether it's like the credit rating agencies or the Bloombergs of the world, they do provide tons of metrics around ESG data, but they're not necessarily looking into smaller companies. They're not necessarily looking into private companies. And I think we will be seeing more and more efforts going toward trying to figure out how do you assess a company that doesn't necessarily have the marketing dollars to have their own ESG reporting. Are they going to be excluded from investment, or is this really the biggest opportunity to figure out how to, assess them and how to invest in them, because maybe others are not looking there. And so, absolutely, we do actually work with a lot of exchanges who are looking to, in a similar manner, solve this challenge. And so, my personal prediction is that we will be seeing more and more of this. I totally agree with you.
Great, and back to the ASEAN remit. GS, what do you see in your side of the world?
Guan, you're muted.
Oh, sorry. I think we are very good in measuring the changes, the carbon footprint, and things like that. But we are still poor in changing the behavior when it comes to climate risk management. So I foresee that going forward, a new kind of environmental or climate-based information ratio being generated, in the sense that the returns are still there on the numerator, but perhaps the denominator could be a reflection of your wastefulness, the company's wastefulness. So if they do something in terms of their waste management, obviously the denominator will reduce, and that would enhance their ESG value. So going forward, in terms of performance, I hope to see new metrics similar to what we have today in terms of the information ratio, where the wastefulness of the company can be measured, and then that forces a behavioral change, leading to a more circular business model. So that will tie in very nicely in terms of how they manage climate risk or environmental risk and things like that.
Great, and let's leave the last word for the Belle Province. So, Jan Christopher, what are you picking up in terms of strategic signal about the future in Montreal or Toronto?
An increasing need to seek out, understand the best fintechs that are out there. So to better solve this problem. So firstly, I'd say it's understanding which ones are. I think there's a lack of awareness around some of them. As mentioned earlier in the show, that and a fintech to report on its triple bottom line can be very challenging as they're just trying to be sustainable on themselves, but they actually do have a huge impact. And to your points where you saw 6 out of 7, I think that trend's not going anywhere anytime soon. So there's a lot of areas that need to be uncovered, and doing so with many different areas of data, it requires a lot of different use cases and a lot of different platforms and companies to solve for it. Now, through time, will we start to see, I did like how you painted a picture of everyone having different platforms and different fintechs. And I almost think that's better versus a consolidated one view in this world. But I'm certain, as anything does, increasingly partnerships are accelerating, and we're starting to see potentially more consolidation. And so there's going to be an even flow of new businesses that get created and those that get consolidated through time. And that's part of the fun of where we invest in, in our name at Holt Exchange, is really to help facilitate that.
And it's great. It was a pleasure to have you today. And I think if one message I think we really wanted to convey today is that really the phenomenal growth of the sector, because really, once again, it's positioned at the intersection where many things, many hot things are happening, and they're like mutually accelerating, to use the Jan's metaphor. It's a multi-level acceleration of finance, economics, corporate strategy, law and regulation, and really fintech and ESG. It's really a match made in heaven. And I want to thank you once again, Jan Christopher in Montreal, Guan Sang in Singapore, Svetla in New York City, and Jules in the studio behind us, and me from Paris. It was a pleasure to be with you today, and hopefully we can have a follow-up roundtable with our friend from Adiva in the next few months. And without further ado, and I want to thank you all for having joined us today.
Hello, good morning, good evening, good afternoon, everyone. This is Peter DeMeo from Singapore, nice and sunny and warm here today with James, Dave, and Chris. We're going to be talking about trends in information security around infrastructure for financial systems. I work for IBM, and my role for the last 4 years is building confidential computing technologies for digital asset infrastructure. I'll just pass it over to James.
Hi, good evening, good morning, wherever you are. I'm James Macleod, Director of Community at Finos. We are the FinTech Open Source Foundation and part of the Linux Foundation. And thank you for inviting me to the panel today.
Dave? Or, sorry, Chris? Sorry.
So you're going around clockwise. Hi everyone. Yeah, my name's Chris Michael. For the last 5 years, I was up until recently leading the development of the UK Open Banking Standard, and also for the last 3 years, I was the co-founder and I've been leading Ozone. We're a software company who develop API solutions for banks in multiple parts of the world, to help them deliver on the promise of open banking, open finance.
Yeah, hi, my name's Dave Tong. I'm the CTO at a fintech company called MoneyHub based in the UK. And so we consume open finance data and active in that space. I'm also the co-chair of the financial grade API working group at the OpenID Foundation, where I kind of work with colleagues around the world, trying to define some good interoperable, secure standards, so that we try and avoid the whole not invented here syndrome, and people keeping on making the same mistakes in financial and wider than financial services.
Great. Well, why don't we just get started, gentlemen? I just think it's nice to kind of look at current events. And just yesterday, in fact, in the U.S., it's still today, I guess. The Department of Treasury, the Office of Financial Assets Control, OFAC, which is responsible for enforcing the Bank Secrecy Act and others, they issued an updated advisory that sort of highlights that the risks associated with, well, in this case, ransomware payments in connection with malicious cyber-enabled activities. Janet Yellen, who's the U.S. Treasury Secretary, recently proclaimed that ransomware and cyber attacks are victimizing businesses large and small across America, and they are, in fact, a direct threat to our economy. These kinds of attacks are increasing in scale and sophistication, frequency. They're victimizing governments, private companies. In fact, in 2020, ransomware payments reached over 400 million US dollars, which is 4 times it was back in 2019. In addition to the millions of dollars that are paid in ransom and the disruption in critical sectors, including financial services, healthcare, and energy, there is an exposure of confidential information, which can actually cause a lot of damage to people. So such payments, not only encourage and enrich malicious actors, but they also, of course, create a vicious cycle, perpetuating and incentivizing additional attacks itself. And so with Chris, now we're moving into this era of open finance, and you've been doing a lot of work in open banking and so forth. How do these kinds of attacks, these trends, how are they affecting financial markets in this space?
Yeah, I think the short answer is we don't really know yet. I think what we've been seeing up until now is most of these threats are aimed at or targeted at the institutions that are the prime source of your data. So if someone wants to get access to your bank account data, they will target your bank. And what we're seeing with this move towards open APIs, it's really starting in most cases, it's starting with open banking, which is, I'm sure we all know, we've got probably a slightly different version of it, but at a high level is the construct by which a customer can give consent to another party to have access to their banking data for a number of different purposes. And the good thing about the model of open banking is that it's based on the premise of trust, that you as a customer trust the third party that you're giving access because they're regulated themselves. And that model has got a lot of benefits, because it means that, yes, there might be a relatively small number of players that will then have access to your financial data, but they're trusted firms. But it does in theory increase the attack opportunity, the surface, if you like, because your data can now exist in your financial data, your banking data can exist in multiple different places. We haven't really seen, I don't think yet, any strong evidence that says it's in the real world actually increased the number of incidents of attacking a financial data. If anything, it may actually reduce it. I don't know. But what we are I suppose all concerned about is this movement of open banking is the tip of the iceberg, because we're seeing a global movement towards, in Australia it's called consumer data right, but a global movement towards customers being able to access their data and share it more widely. And at a high level, that does potentially increase the risk quite significantly if valuable data that belongs to an individual can exist all over the place. And I don't think we've got a solution to this yet, but I think it's something that we need to think about very carefully. What I'm a very strong advocate of, though, is that this shouldn't be used as an excuse to stop or slow down the movement of open banking, open finance, open everything, because in general the benefits are very significant. And as long as data is being shared between trusted firms who are regulated and held to account, then I think the risk is relatively small. And I'm not sure it's a bigger risk than we've got at the moment. If anything, as I said, it could reduce the risk, because the way that a lot of attacks happen at the moment, a lot of the data is accessed, whether it's phishing or other methods. I think inherently, if you put in a secure framework for open banking, and you base it on strong standards, and I think Dave's much more an expert in this than I am, but a strong security model and strong standards are a very good way of protecting against these sort of attacks anyway.
Great.
It's amazing.
Thanks,
I mean, I hope it's okay for me to come in after Chris. So that was actually a really great introduction, and thank you, Peter, for opening the conversation as well. It'd be good to reflect on, what the outcome, of these types of cyber attacks can actually be. Now, fortunately, I've not actually, been involved in anything, within financial services, as a result of ransomware, but I have been involved in ransomware outcome through Garmin and personal data through a Garmin device. Recently, I was training for like a half marathon, and I remember Garmin were victims of ransomware, where all of their data was encrypted within their own databases, and it meant that their entire, and I think it was to do with their mapping, was down, not only for home users, who use Garmin devices to track, their exercise wherever it may be, but it also affected pilots and people who were navigating, around certain, maps, and needed geolocation to get, from A to B. And that was actually a big problem, because data is actually fundamental to, services operating, so you might have software that operates and actually, provides data in, data out, it's accountable for UX and, user experience. But without the data there, without you being able to interrogate your data and maybe, update data where it needs to live, a system is actually rendered useless. And there was actually a bigger impact. And I'm not, living in the US, you can probably tell by my accent, I live in the UK, but I understand that either, an oil pipe or, a gas pipeline within the US was actually rendered useless quite recently due to a ransomware attack. And so as you kind of look at, the scenarios that we have, from me with my, personal device that I'm wearing, I can't go out running and track my running. It's a nuisance. But, then it scales up to people not, being able to fill their cars up with gas or petrol. And then if you scale that up into, personal finance, and how a ransomware attack could actually render your whole banking, infrastructure invalid, from ATMs through to, personal finances, loans, mortgages, credit cards, that would also impact open banking, which actually feeds off of all of this information from the source of banking. Ransomware is actually a massive issue, and it's something that we need to take really seriously. And the attack vectors that we were discussing previously are from multiple different angles. And so knowing the threat is out there and it's big, and it's actually something that we should be aware of, understanding what those attack vectors and how people manipulate kind of like lots of different entry points is actually really important. And, it'd be really interesting to see, number one, whether people agree with, the devastation that it's caused personally or to, a global infrastructure, if I got that right. And number two, as engineers and scientists and people on the ground, people working in offices, what do we actually need to do to safeguard ourselves against that? How seriously should, my grandmother, at home, disposing of, paper statements, with her address details on it, should she be aware of this? Can her details be used to manipulate, the banking system? To what extent do we need to be aware of? That's what I'd be really interested in. Maybe Dave, from Money Hub, it'll be really interesting to see whether, you have to, account for all of this, these type of attack vectors from where you sit within FinTech.
Yeah, we do, and I suppose for us, we see ourselves as a tech company, and so it's that's just part of how we operate. That on just principles of least privilege and just following a lot of best security practices. I think part of the problem is that over the last 20-30 years, most companies, especially most big companies, have essentially become tech companies or have significant tech parts of their infrastructure, yet they don't run like tech companies. And that's where they're opened up. And so, I think ransomware is most common in manufacturing industries where, yes, they are dependent on technology, and therefore, ransomware can take them out. And but they're not necessarily seen as tech companies or running like tech companies, and therefore maybe not following best practices. And I suppose from my perspective, kind of touching back on what Chris was saying about data, it's kind of at a high level, it's the same thing. Some firms, once an attacker gets in, perhaps ransomware is the best way, and encrypting data and shutting systems down. For other industries, if we look at kind of like the Equifax, data breach, if a company has significant data that actually can be accessed, well, that's what the attackers are going to do. And in other industries, kind of payments are going to be made and money is going to be stolen. So, but at the end of the day, I suppose it's attackers getting in past the security. And I think that the crazy thing is, to be honest, that there's so many, like, the technology to make these attacks a lot less likely has existed for quite a while. But we're generally as an industry, it's quite hard for things to update. So, I suppose for a very large multinational firm recently, I won't mention their name, I had to sign up for an account, and I had to, enter a password, and there were all these password restrictions, and the password expiry, like it was only allowed to last for 90 days, I think. I had to answer about 4 different security questions about, I don't know, my mother's maiden name, and I know the first car, and and then a load of questions that I couldn't remember. But the irony is that's all old. That, like, NIST recommends not to do any of those things, and yet it's still common practice. Anytime someone asks me to rotate my password, my often email to them is, "Oh, have you suffered a breach?" Because the NIST guidelines is that's the only time that you ask users to rotate their password. Yeah, so there's a lot of bad security practices which are endemic. And maybe just finishing off, the good news is I did see a headline from Microsoft the other day where they are finally allowing people to have accounts without passwords. I mean, it's just crazy that we're still using passwords in this day and age, especially when to protect access to, let's say, very expensive industrial machinery, or to protect access to kind of, significant financial infrastructure. A lot of places are still using passwords and are still using authentication methods which can be easily phished. And that doesn't need to be the case. I mean, I've got, I'll just pull it out. I've got, a little YubiKey, very, very, very tiny. But with this, the accounts I've got protected with this, an attacker, even if they know all my passwords, even if they manage to hack, my SMS and my phone, hack my email, they can't get in without this key. And this tech has existed for ages. So I suppose, yeah, that's where I'd be coming from, that we need to somehow try and get these best practices better adopted across industries. And yeah, that's, my particular area of expertise is on the API level, but I think more generally, best security practices, they exist. They're just not being implemented.
Yeah, I would say, I would kind of building on that. Recently, there's a study that was done that, especially with the pandemic and everybody's working from home and bring your own devices and all, what kind of impact is that having on the enterprise? And the enterprise, quite frankly, is really still using, like you're talking about passwords, they're still using perimeter-based network security, right? Which is basically the golden wall. Once you get inside, okay, game on, right? And the principles of zero trust architecture, NIST 800, are starting to, from a trend perspective on the other side, I would call that one too, in terms of the adoption, just even recognizing that, beyond identity and credentials, you have access management to all kinds of resources, operations, endpoints, hosting environments, interconnections. And all of this, should be authentication and authorization, like in a real-time basis, for the smallest possible, scope as you can have it. And and it should be kind of driven by policy, right? And that policy should be specific to a particular scenario instead of just being a broad-based. And then there's got to be some kind of enforcement mechanism, for the policy itself. In digital assets, I often joke about this, but it's kind of true. The entire digital assets, value, if you will, is now in the trillions of dollars, right? Now, you may not subscribe to that whole thing, but it is. And I would say 85-90% of those funds are sitting on Amazon, okay? And Amazon's x86 commodity servers that, quite frankly, have to be maintained by administrators, and others. And people can get to that stuff, okay? We kind of joke about it, but actually, there's a number of scenarios where things actually are sort of happening. We saw recently a Pakistani national was sentenced to 12 years in jail because he was running this ring where basically he paid off AT&T employees to set up fake companies and invoices showing payments being made presumably to some company, to AT&T or whatever, and basically turned into a big SIM swapping kind of a thing, right? Where like thousands of people were SIM swapped, and then their accounts, okay, because they weren't using Dave or YubiKey, they were using SMS, for their second factor, and guess what? They lost their funds. And in crypto, they lost their wallets, and millions of dollars were lost that way, right? So it's a real problem, and we're seeing constantly these examples. In IBM, we talk about something very fundamental. It's something called operational assurance and technical assurance, okay? Now, operational assurance is like, yep, we've got the CEO to the company saying, yep, we're going to instill policies and procedures where everyone's going to behave themselves. Yeah. And then the cloud provider, pick one, their administrative personnel and their operations personnel. Yep. We're going to go ahead and follow the rules. Okay. And if everybody does that, it's no problem. The problem is that not everyone does that. And when you're talking about vast sums of money, crypto or otherwise, okay, and you're talking about an hourly employee, and they think they get away with it, things happen, right? And things happen is this: they have what's called operational access to these servers, and these servers generally are not protected in any particular way. There's no, you're not running an encrypted memory or a protected memory or something to that effect. And and they can access these things. They can access policies. For example, in my world, a few weeks ago, there was one of the largest crypto exchanges that basically had the preeminent security in place called Liquid Exchange out of Tokyo. And they use something called multi-party computation, which is a technique where you kind of take a private key that you use to access these accounts and make trades and so forth. And instead of actually having like a quote, a physical key, okay, what you do is you generate key shares and you distribute it geographically, right? And then when it comes time to do a transaction, you don't actually have to physically recreate this thing. You don't have to get everybody in the same place. Everybody simply, uses their key share and they approve the transaction, and then the collection of the quorum of them all approving, then you have some fancy math that essentially signs those transactions without actually having the physical key. All right. Now, that technology, secure multi-party computation, is what all the major financial firms are looking at as they move from traditional finance into digital asset finance. Okay. And Liquid used the same. In fact, Liquid used the preeminent provider of secure multi-party computation. They themselves have a FIPS rating, a FIPS 140-2 level 2, okay, rating, all right, which is the highest you can get for software crypto. And still Liquid was attacked and wallets liquidated at Liquid. I just thought of that, for the tune of $80 million. How is this possible? Well, turns out, okay, we don't actually know why it's possible. We don't really know, because Liquid's never actually come out and said, hey, this is how we got hacked, right? But if you know something about it, you can get a pretty good idea about what happened, right? So, if you have secure multi-party computation and you're pretty certain that those aspects are not going to be, hacked, okay, because it's difficult to do that, then what is hacked? Well, it's the orchestration. In this case, I think what it was, you have these signing bots that have been given the approval, if you will, through policy that under a certain threshold, they can go ahead and automate transactions. And by changing that policy without anyone really knowing about it, they all of a sudden were empowered to do a lot more, right? So what happened? Well, it's the policy that got changed. The policy, the rules, if you will, okay? And in fact, one of the key aspects that the Zero Trust architecture talks about actually is policy and protecting it, and protecting the enforcement mechanisms as well. And what we think happened here is that last November, there was another hack at Liquid, and it was no funds were lost, and people didn't really pay much attention. They said, well, emails were compromised. But what I think really happened was administrators, their accounts were socially engineered, okay? And it was the administrator who then had the ability to change the policy. So then they lie in wait. In this case, they almost for 10 months. And then boom, when no one's really paying attention, in my mind, no offense to Liquid, it happens and the policy is changed. So even when you have, you would say, the most secure technologies in place, when you are applying the principles of real-time authentication and authorization at the transaction level, you can still be vulnerable by virtue of the fact that if you haven't secured the rules and the workflows, you're still going to have problems.
Now that is a really interesting insight. And sorry, Peter, I'm actually feeding back on your microphone. There you go. Thank you very much for muting yourself. That's really interesting because coming from an engineering background, I often look at, what are the mitigations, for bad actors actually getting into your software? And so, when you are working within a bank, so whether you're an IBM engineer, working in a data center that is, being run on behalf of a bank, under strict regulation, there'll be segregation of data, there'll be segregation of the actual physical boxes themselves. So if you are in a private cloud or whether you're in a physical data center of mainframes, your data and all of the computation that's actually happening against that data won't be run, on the same physical boxes as anybody else. And so, the bleeding of, computation processing, it just won't kind of like exist, with another bank or even a non-banking system. And then you also look at the compliance around, physical networks within a bank, and how you actually stop any rogue software making it through firewalls, through tightening down policy on people's individual laptops, or even stopping certain software from getting through the firewall. There's a lot of physical constraints that you can actually put around a bank to stop all of this stuff getting in. And I'm not saying that there aren't any vulnerabilities there. That vulnerabilities exist, like what you were saying. A bad actor, being a physical human, could come in through the front door and do something like taking data and using SMS to exchange it with somebody else, or sharing passwords like what Dave was saying, or picking up people's identities out of recycle bins outside their front doors. But when it comes to the actual changing of a physical policy within software engineering, we go through lots of stringent testing. We'll run scenarios. We'll have TDD that looks at all of the functions that you're actually writing, and make sure the outcomes actually fall in line with the inputs. You'll maybe use BDD in order to do user-driven or business-driven development. So all of the engagement is actually happening through the UI, and so everybody understands how your software is engaging with the user, and then how that software is engaging with the data. But the actual policy, that an administrator applies at the policy level, does that get tested? Do you actually have to go through the same level of rigor to update a policy, and take it through all of the various different development, and then pre-production through to production scenarios, in order to apply that in the environment where it could actually, do swaps and, send transactions to places? Is that where, that particular liquid vulnerability will be, because somebody was able to just go into wherever they're storing those policies and just update a system through, some form of UI that's, browser based? It would be good to know whether that would have been a physical, scenario that could have played out there.
Yeah, I mean, it's interesting. Certainly there's going to be process involved with a human. But the other thing, James, that we're seeing too, from a trend perspective, is the use of artificial intelligence and other software-based agents to actually do and manage security issues and enterprise networks as well from attacks. So they call this non-person entities in the zero trust world. And really the big risk there is kind of getting to your point, like what's the bar? If everybody's sort of like, oh, it's artificial intelligence, we're just going to trust this thing, right? But where you come in with problems is that you have this sort of possibility for false positives, right? Which are essentially innocuous actions mistaken for attacks, and then the other side of it, which is false negatives, which are basically attacks that are mistaken for normal activity, and these kinds of things, happen, I would say, at a greater potential when you sort of like, oh, I'm just going to let the AI bot handle this, right? So you have customer service issues, of course, that come out of that, right? And then more than likely, you could also get, compromised and not know it again, because you're sort of relying on this bot to sort of look after things, especially if you're trying to economize resources. And how we've heard this story before, right? Everyone's trying to reduce, resource, administrative staff, operations staff, wherever possible, automate, and boom, you got yourself some malware.
Yeah, I mean, I was just going to add, I mean, it is scary when you see, people who are really sort of, should be on the ball when it comes to security, essentially, having vulnerabilities. And, the attack's always going to go for the weakest link. And, the weakest link often is a human or some code or policy that a human has written. So, I would say it's impossible to 100% protect against some of these things. But I suppose where my hope would be, and this is where I think things like GDPR are helpful, and I hope there's almost more enforcement, is that when there is a financial cost to either a data breach or just the reputational loss, or the money to ransomware and the reputational loss around that, I think that forces companies to change. And what I think we're seeing with some insurance, it's not enough at the moment, but insurance can force people to have better security policies to kind of implement things better in the same way as physical security. You don't get things paid out if, I don't know, you don't have your fire extinguisher regularly checked and things like that. I think we're a little bit behind, but hopefully we can push towards the same thing with a lot of security infrastructure. But I suppose what the realization is that it can't be that the big companies and the people who are in the space, they can pay the experts and they can build all their own solutions, but most companies can't. And that's where I think we need international open standards. We need things, so on the API layer, there's quite a lot of existing standards already, and that's part of the work we do with the OpenID Foundation. But when it comes to authentication, there's a kind of FIDO standards, and there's a new initiative launched recently, called GAIN, the kind of globally assured identity network. And so my hope is these things, they seem a bit boring and they don't seem very kind of interesting, but I think kind of interoperable security standards and security mechanisms actually can have a huge impact on sort of overall security, because it can get to the long tail. Your big cloud companies and big crypto companies, it sort of doesn't affect them. They're going to do their own thing anyway. But this long tail of so many, SMEs and companies, who are affected by ransomware, affected by all of these things, if there are the right standards. And I mean, I would, just quickly going back on your Amazon vulnerability. Yes, if I'm a crypto exchange, Amazon, Amazon or Azure or wherever, Google, yes, I need to kind of include that in my threat model. But for most smaller companies, or, actually, it probably is a lot better to move as much stuff as possible to one of the big cloud providers, and to, where possible, use their kind of off-the-shelf services and not build your own systems. So it's kind of, I think it's almost, you have different threat models depending on who you are. Yeah, a crypto exchange, definitely, you got to be aware of an Amazon employee coming in and taking your box. But your average SME, far better that they're with one of the big cloud providers than their own systems.
Yeah, I mean, I think you're right, especially since the clouds are in fact adopting these zero trust principles in their own infrastructure, so they're going to know better, et cetera. And I think, here's a little IBM commercial. When I was mentioning about operational assurance, and that's what all the clouds provide today. So Dave, if you're going to throw your stuff onto a cloud, then why not throw it into a cloud that doesn't offer operational, but in fact offers what's called technical assurance? So in other words, now we're going to sort of talk about technology that prevents administrators from being evil, hard stop, and prevents, when you're deploying applications into the cloud, it also prevents malware and backdoors from being introduced as well, right? Because you can do a third-party attestation as part of the build cycle itself. So there are technical ways to sort of limit the blast radius with respect to moving to cloud and taking advantage, of these more mature operational practices as you're talking about.
Yeah, I think I don't think there's no kind of silver bullet solution to this. I think there are two kind of things that I think are quite sort of relevant and important in this area. Dave, you think you touched on one of them, and it's around identity and having better standards around identity. I mean, it's a bit of a tough one, because there are a lot of kind of lobbyists against digital identity, and kind of saying it infringes people's privacy and etc. But having strong digital identity that's kind of trusted, to access or use various systems, I think is a good way of ensuring that actors are known, that who's accessing a system, and there's an audit trail, etc. I think it's very painful, slow progress. Having been involved in this kind of identity space for a number of years now, it's quite frustrating, because things are moving very slowly. It's because it's a difficult problem to solve, I guess. But I think the other thing is the fact that we are at last starting to see big businesses embrace the cloud, and starting to think about, I'm a big business, I'm a bank or whatever, do I really need to manage my own data centers, my own hardware? Wouldn't I be better off letting Amazon, IBM, Oracle, Microsoft, someone else manage that. There's still quite a lot of misconceptions and misunderstanding and vested interests and things in that space. But as a general rule, I always think if you, whatever size company you are, you've always got to think, right, do I try and do this myself, or do I trust someone else who can probably do it a lot better? Almost no company would try and build their own email system now, right? You'd use Microsoft or Gmail or something. Almost no big company now would try and use, even if they're using Microsoft, almost no big company will now try and manage their own mail service. So I think that all of these things are, I think, important steps. But yeah, my underlying concern about all of this is the time it takes, both regulations to move in this space and also big businesses to move in this space. And I think that's where there's a bigger opportunity for bad actors to play, because big businesses and governments don't move particularly quickly.
Absolutely. And what I was actually going to reflect on is that within the cloud space, all of the cloud service providers need to adhere to, when I say local banking policy, I mean the policies that are actually being applied by the bank that they're representing, and also the regulation that exists within the country or the region globally in which they are operating. But something that I would like to point out, so I've kind of made some notes as people are talking, and the thing that I've noticed is that there are lots of different angles. And so Peter, you're absolutely right. I mean, infrastructure and making sure that the way that the cloud is operating, all the way down to the way that the people within those data centers are looking after the hardware, and you can trust those people. That's absolutely right. You need to make sure that whether you're a bank, whether you're working in cryptocurrency or fintech, you trust the people on the ground, and you actually trust the physical hardware and where that data is stored. And I know that IBM do actually provide physical data centers which are like hardened bunkers that people can't get into. And I'm certainly hoping that the other cloud providers are providing similar for banks who are moving in their direction as well. But I do also think that although there isn't a silver bullet, because the attack vectors are so broad, and we've had some really great examples today. I do think that there are some, open standards and open policies and transparency that can actually help mitigate this, rather than centralizing, the mitigation of risk from, security and breaches and ransomware and, other types of malware. I think, like Dave was saying, having open standards, like open banking, that people can actually scrutinize, and where people, who are also looking in these areas can come together and talk through how do we actually recognize, where security is being breached, and how can we actually react to that, in the strongest possible ways. And if, something is recognized, how can we actually update that standard, and get the new version agreed through industry up and out there for other people to follow. I think that kind of accelerates, the way that we actually recognize and adapt and move forward and secure our systems from a logical standards point of view within software engineering. But then something that I wanted to push out there, when it actually comes to keeping people's data safe. So Chris, within open banking, it's about the distribution and decentralization, of people's data. It's almost pushing the data back to the owner, which is the individual customer. Do you think that having decentralized data, through blockchain, hyperledger, other types of, decentralized data mechanisms, through Ethereum or, other blockchains, Bitcoin, etc. Do you think that, having a logical answer to this, so we can see where fraudulent activity is taking place on a node rather than within one centralized database, could also be, an approach that mitigates, the hijacking of people's data? So if you can see that one particular node on the blockchain has been compromised, you can actually isolate that, because compared to, all of the other peers around it, that one, doesn't adhere to the latest version, or, is different to everything else.
I'll answer a little bit, but I think it's maybe also more one for Dave. But it's something that we've thought about a lot, and there have been a lot of discussions around this, around how do you kind of, protect data that flows between lots of different places. And one of the concerns about a truly decentralized model is that it does raise significant challenges for firms that offer services based on combining data from different sources, enriching, enhancing, transforming that data. It's quite difficult to do that using machine learning type techniques, amongst other things, but it's quite difficult to do that if all the data is decentralized. So if you're a financial service firm and you want to categorize data, combine it with other data, enrich it, and provide extra value to your customers, it's quite difficult to do that if all the data is decentralized. But I'll let Dave talk a bit more about that. But I get your point. In theory, it might mitigate and solve some of these issues.
Yeah, look, thanks, Chris. I'd agree, to be honest. My personal opinion is that it's great in theory, but even if we look at the crypto today, it's pretty centralized. The fact we're talking about these exchanges and wallets getting compromised, it's flies in the face of how it was supposed to be originally, that people would have their own private keys on their own devices and would trust no one. So I think that just shows people, we need trusted intermediaries in to function in this digital world. Apart from, unless you want to be you'll get some real hardcore geeks who can kind of manage everything themselves. And there's a small niche for those, but for most people, it's about a value exchange. That they're actually happy to share the data. They want regulation around it. And that's where I think, things, sometimes, some of these problems I don't think can be solved purely with technology. They need policy, and they need things like GDPR, which, while not perfect, is a step in the right direction. And so I think that's for most end users, they don't really care about things like, decentralized data. They want to be able to access a good service, which either saves them money, saves them time, or makes their life better. And they don't really care how that's provided. I do think there are some cool things we can do technology-wise around privacy, which is quite relevant in kind of some of these things, around vaccine passports and COVID passes. Essentially, that there are things we can do with technology so that I can prove that I'm over 18 without proving, without having to show my name and address and date of birth. That there are ways. So I think that's an area where kind of a little bit more of this. Not just sharing all of your data, that's an area where the technology exists, and we just need to somehow get that kind of easier to use and more out there. But in terms of kind of just things like open banking and open finance, I think the regulated model is a better model. So yes, the data is going to be concentrated in a few places, but let's make sure it's well regulated, and let's make sure there are consequences if that data goes. And the thing, just finishing on this, the thing with data is a bit different from payments or transactions. Data can be replicated, and even if you can put some strict physical controls on a device, someone can take a picture of a data, it's very difficult to kind of lock data down and to kind of add some sort of tracing on where a data breach occurred. It's pretty much impossible in the real world. So, let's rather just try and have better policies and try and enforce them.
That's great. Thanks, Dave. I think the other thing about the centralization part is, who you calling when you got problems? Where's the help desk? So that's often something people think about. And, interesting, we don't have enough time to talk about self-sovereign identity and zero knowledge proofs, but certainly that is another topic when it comes to identity and how do we identify ourselves? And quite frankly, why do we have to give away our identity to all these different people and agencies and governments? We don't even own our own identity. I'm going to go off a little tangent. Who we don't issue our own driver's license, but that's what people accept for your identity, at least in the US, right? So we've got a whole lot of other things to work out too, I think. So guys, thanks so much for your time. I think we're out now for this particular panel. So James, Dave, Chris, thank you very much. Appreciate it. And everyone, if you have any comments or so, just throw them into the chat and someone will take care of it. Thank you very much.
Thanks a lot.